So, same thing, I will not do introductions. I'd rather the panel work for their living, so they introduce themselves and explain, justify their seat on the panel, starting on my far right, Jason.
Jason Cogley, I'm a managing director in Fiera Infrastructure. I help run our global infrastructure strategy based here in London, primarily covering the UK and Europe, looking at all aspects of our business, investing and managing our investments.
Peter? Yeah. Hi, Peter Lindbom. I'm a portfolio manager at Ingka Investments. Ingka is the main operator of IKEA stores globally, and I'm in charge of the alternative investments portfolio.
I'm David Allen. I'm a partner at Baker McKenzie, a law firm. I head up our transactional strategy across Europe. Before that, I was our global head of financial sponsors. So I guess I've got quite a good insight around transaction volumes, both in the UK, across Europe and globally.
Absolutely. Last but not least, Dougie.
Dougie Sutherland. I'm Chief Executive of an energy from waste company called Cory, based in London. I guess I've been involved in infrastructure from the very early days when I was in the Treasury with the launch of the PFI, and I've basically been in infrastructure either in the government side or in the private sector side as a contractor, an investor, an operator since about '94.
Okay, we're going to start by getting a sense of, because not every pension fund has it, although people may want more of it, just a sense of what infrastructure is and the benefits to a fund. David, you want to start on that? So why would a pension fund or any long-term institutional fund want infrastructure?
I think infrastructure as an asset class is attractive because it's been much more stable as an asset class than, for example, some of the assets that private equity has invested in over the years. So it creates a much more stable return, a much more predictable yield from year on year. Whereas with private equity, typically many of the private equity deals that have been done are all about sort of exponential capital growth and much greater risk and return.
Any other comments, Peter? What's your interest in infrastructure and why?
Yeah, all that obviously. Reduced volatility, a lower correlation to our other assets, predictability and cash yield, but from our perspective also a great opportunity to invest sustainably and create some real change in infrastructure projects, turning brown to green, add more green. Along those lines is very important for us as well.
Okay, Dougie?
I suppose maybe just
sorry?
adding
Sure.
Briefly to that.
Jason? I wasn't.
I guess there's a...
Okay, this panel's out of control already. Go ahead, Jason.
I guess there's a why do infrastructure investments perform like that? And I think it's because the basis on which the industry blossomed, and Dougie was there at the very beginning. I was also involved in the PPP space here in the UK for my sins, is essentially the investments that we're investing in, whether it be our infrastructure strategy or others like it, are essential infrastructure assets providing a critical service to the community, and they often come with barriers to entry and contract revenue visibility, and it's those fundamental ingredients, if you like, are what makes infrastructure so unique and such a stable performing asset class when compared to others. Dougie, you wanted to say something as well?
Yeah, I think one of the previous speakers said it's not their first rodeo going through choppy waters. I've definitely been quite a few of those over the few years for lots of reasons, but I do remember one economic downturn in the company where I was responsible for their PFI investments, and we were forced to sell our PFI investments because the actuaries turned around and said, the market's collapsed, we're now overweight in PFI because they're the ones that haven't, and we were forced to sell. I'm a civil engineer, I never really understood that approach to risk, but I think that's sort of been the case even if you look over the last 3 or 4 years. And if you look at the business that I run, and we've been through some very choppy times through COVID because, and through high inflation areas, is that actually in 2019, 2020, 2021, they've been our best years, actually. And you've got to say, well, why is that? Well, you know, there are a number of reasons for that. There is a local authority to underpin, you know, what we do. You know, have a statutory duty to get rid of their waste. And you probably don't think about your waste very much. In fact, most people, you sort of throw it out and it's sort of gone. But actually, we do produce a hell of a lot of waste. And even during COVID, you know, when the streets, particularly if anyone went to the city, it was just empty. But people moved, and they moved elsewhere. And probably the worst that we felt was a 4% drop in waste, total waste volumes in London. And that was it, because people went home. You know, we could see there were a lot more bottles being produced. So, you know, they were drinking a lot more at home. There's a lot more Amazon, but people continue to consume and throw out waste. And so we didn't feel it. We also didn't feel it because, particularly in London and the southeast, there just isn't enough infrastructure to deal with waste. So we are burying a lot of it. You know, we're exporting a lot of it, but we're not properly processing it. And so even during that time when it was 4% down, we just could not cope with the amount of waste that people wanted to come to us to process it. So, you know, it's pretty resilient during tough times. Underlying all of that, you know, we've had to deal with high inflation, but just about all of our income is index linked, you know, mainly RPI, some CPI. We have to deal with real issues of keeping people on the front line, but that's normal for us. But during COVID, we have to keep on going. We don't have this debate about how many people come back to the office, actually. We live in a slightly different world to that. But people kept on working. We've had union issues, but as long as you look after your staff, they won't go on strikes. We've never had one of those sorts of issues. So operationally, it's been pretty tough, I have to say, and supply chains have been, you know, particularly difficult to deal with. But that's sort of our day job, just slightly more difficult in the last 3 years. But the fundamentals of mean we've had a better year. I'm not going to you know, say what I think this year, so I'll probably kill myself because we've got not long to go, but it's looking good for this year as well through difficult times.
Okay. I love the way Dougie blames the actuaries, and then
I still don't understand that, by the way, but you know.
If not the investment consultants, and I'm all three of those, so that's really helpful. Yeah. He's endeared himself to me. In many ways, infrastructure is the ultimate buy and hold for a pension fund. It is very long term. It has considerable inflation sensitivity, certainly on the income yield. Is that fair, Jason? Is that? And why has it only appeared, say, in UK pension fund in the last decade, say? I mean, Canadian and Australian pension funds would have had it for many decades. So why sudden interest and growth?
Yeah, it's a good question. So it goes back to how did what gave birth to the infrastructure industry. And I was in an investment bank that's closely associated with the formation and if you like, the industrialisation of infrastructure. And I can remember the conversations. We literally copy and paste private equity type structures, closed-ended funds, and the fee structures from that industry, where the assets you're investing in are, as you point out, fundamentally different. So you have long-lived assets, whether it be electricity or water utility, a PP project, whether it be a road or whatnot. It's not necessarily best suited that infrastructure like that exists in a closed-ended fund, which will have to sell those investments at some point in the fund's life. The nature of infrastructure is very well suited to open-ended funds, some evergreen fund technologies which are around. We find that as a buy and hold investor and perpetually raising capital as well as investing and managing in our assets, we can provide a number of features to our management teams which are attractive. They don't have to worry about the exit 5 years after the new investor comes in. We can continue to support the management team with capital from the fund that invested in them in the first place, not worrying about vintage risk, which becomes an issue for some closed-ended strategies. So And for me, I certainly over my career have evolved going from closed-ended investing through evergreen and into open-ended, and it is very clearly very well suited to the asset.
Okay. David, the regulatory legal oversight of all of this is getting easier, more difficult,
Yeah, I mean,
more expensive?
maybe just kind of picking up what Jason was saying on around closed-end versus open-ended funds. And this is a trend that I find really interesting, that maybe 5-10 years ago, I'd be talking to a lot of pension funds across Europe where they would be invested in closed-end infrastructure funds and be quite frustrated that there were trophy assets within these funds that they had been desperate to get exposure to, knowing that the fund would want to achieve a liquidity event for those particular assets after time because of the closed-end fund model. And what's been fascinating over the last period has been the emergence of continuation funds for closed-end funds. And I think many closed-end funds, not just in infrastructure but more broadly, have recognised that when you have those trophy assets that have very predictable, long-term, stable returns, you don't want to exit it. And therefore the emergence of the continuation fund really creates this hybrid between the two.
Yeah. Peter, any comment on
From an LP perspective,
actual legal and actual regulatory overtone?
no, yeah, legal and regulation is increasing nightmare, of course. But in terms of closed and open, and I'd say the pros and cons with both. Obviously, the main argument for a closed-end fund is that you realize returns. You sell if you get a good price. Well, as Jason said, obviously it takes many years to build a portfolio, and it's sometimes a shame to sell it just because you have to. If you can just stay on and have a nice cash yield and have inflation protection and all that. So it depends. I'd say in the core plus space, I'd say it makes more sense with evergreen, whereas in value add and more greenfield strategies, I think you move down in the expected IRR as you build out and as you go from greenfield to brownfield, and sometimes it makes sense to sell. So it depends. I think we do both. I think there's a place for both open and closed end, but that said, all holding periods have increased, and everything takes more time these days than 20 years ago. So you need to be very long term about either way you go.
The pension funds, certainly that I'm associated with, would tend to want existing operational assets and particularly harvest the investment income from them, as opposed to build first. How does everyone feel about that? I mean, what are the advantages or disadvantages? And I think there's an insatiable demand for infrastructure. There's also probably an enormous supply, but they often don't marry up terribly well. And does build new infrastructure, is that the only way we'll get the infrastructure we need? Or just swapping it amongst different owners, does that really improve the overall infrastructure capacity?
I like greenfield, investing with managers with a clear vision and with that entrepreneurial spirit to really create something new, something better, rather than just allocating to existing projects. I think it makes more sense to pay all these fees to someone who actually builds and creates something new, or at least change something, rebuild it, repurpose, something like that. Like you are doing at Cory, which we really like. Obviously more risk, capex inflation and all that, but in terms of environmental impact and all that, you get much more bang for the buck if you create something new.
Dougie, you clearly want to speak on this subject.
Well, I can't really talk about closed-end evergreen. That's not really my thing. But what I would say is the underlying life of these assets is pretty long, actually. Do you know what I mean? So you can't lose sight of that. And even if you think about something like waste assets, which are operating under 1,000 degrees centigrade, 70, 80 bar, they're under a lot of stress. Their design life is 40, 50 years. And if you look somewhere like Germany, which has been doing EFW and coal for a very long time, in the EFW assets, 25% of their fleet is over 40 years old. So I think at one point, these things will last, but you've got to constantly invest into them to make sure that they are delivering. And I think investing into them is going to be, of the existing assets, is particularly important when we're looking at how do we make sure we decarbonise. So I think there is, and that's something that takes a lot of my time at the moment, is looking at the decarbonisation strategies for the business, particularly in waste, which is a very hard to abate sector. But that's something which I'm very focused on. On the new assets, I think clearly there is more risk in developing new assets. And you've got to look at the specifics of each one that you're prepared to invest into. In our particular case, I think it's really important, the technology you use, be careful what you do with technology, and going into new areas. But if I look at what's happened in the last, 18 months, 2 years with high inflation, capex prices for D&B projects, EPC have gone up very, very significantly, particularly because of power coming through into structural steel, even things like reinforcing bars. They really have gone up significantly in concrete. So you would probably anticipate that costs have gone up by 20% probably for an EPC contract in the last 20 years. And added to that, contractors have become quite risk averse. And whether that be Brexit, the volatility in pricing. So we've had to get our heads around all of that. What we're seeing at the moment is that prices are levelling, if not coming down, but who wants to predict the future? So I think that is slightly improving. And we're starting to see contractors starting to be a bit less risk averse. They'll be able to sort of back some of this off. You typically see that when you're heading towards, dare I say, a construction downturn. And I'm anticipating that will be the case, particularly as government is going to back off. I'm sure that they're going to cut their capex spend, and that will back off, and that will force contractors to take a bit more risk. So I think it's an interesting market. In our particular case, again, our income is RPI linked or CPI linked. So while we might get hit with a 20% hit in price at the moment, we're entering into 15, 20-year, 10-year contracts, which are RPI linked, which are significantly mitigating that. So we're managing to be able to develop. So our context means that greenfield, you've got to be on it. Careful what you do. That's true of any greenfield site, but actually funding it and making returns on it, because we're linked to, we're index linked in our income, make the returns, still good.
Jason, I think you mentioned scale. Let me take you back, and certainly in the public sector in England and Wales, under the Osborne, the pooling in England and Wales was about getting scale to enable access to infrastructure. I do wonder myself, is scaling always a big positive? Because someone mentioned trophy assets, for example, the first to be hugely overvalued. You're competing against every sovereign wealth fund in the world and all the Canadian and Australian pension funds. Do you want? I probably shouldn't say this, but I will. I once bid just over 500 million for an infrastructure asset, and my God, did I not want to win it, because I knew it would be, sorry, not me personally, on behalf of a fund. We didn't want to win it. Is there a sort of winner's curse? Or is scale always such a good thing? And is that what's stopping perhaps smaller pension funds from getting the access we think they probably should?
I think we used to, certainly at Macquarie, we used to refer to that as buyer's remorse. Bidding hard for an investment. And I'd say, obviously, at Fiera, we don't do that. We're very measured and disciplined in what we pay for our investments. But I mean, I think that the pooling of the local authority pension schemes, such as it is, it was a good idea in principle for UK local authorities in terms of being able to create scale and negotiate better fees from their managers. That's a good, sensible thing. Organising that available capital to invest in infrastructure is a good thing. I think that whether or not people are investing in greenfield infrastructure or recycling operating infrastructure, if you're increasing the pool of infrastructure, you're increasing the pool of capital, particularly in pension schemes that maybe keep increasing their portfolios, that's available in the sector, and the money will find its way into projects and be able to fund those. But going back to your point about scale, yes, with the larger size of the schemes, then potentially partnering with some larger fund managers, there is maybe a larger number of larger ticket investors chasing a relatively finite pool of investment opportunities, and that has created a supply-demand imbalance at the large cap end of the market, bidding down or bidding up prices, bidding down returns that people are willing to accept for their investments. And that's in part where we consciously position ourselves in the mid-market. So smaller transactions for us, typically sub $1 billion enterprise values, where it's very obvious. There's enough articles and research about it now, but there's certainly compared to the large cap space, a larger number of opportunities and a fewer number of managers chasing those. So like other strategies within Fiera, we see these a better opportunity to maximise returns, be able to follow on an initial investment with further investments, improve returns for our investors.
Peter, on the scale point, what's your actual experience? Positive, negative? Do you wish you'd 10 times the amount of money? And not that I know how much that is, incidentally. I'm not specifically asking because it's probably specific to you.
Hard to tell. It's obviously more of a limited supply of assets compared to real estate or private equity. So you can't expect to deploy fast. It helps with larger tickets, obviously, and negotiating better terms and getting access to co-investments and so on. But no, it takes a long time to deploy, and you need to be patient, definitely. Yeah. And you can't really do any sort of market timing. It's about finding the right managers that you like and trust, and work over many years to deploy in the right assets at the right time, and trust that they can execute the right opportunities, because it takes 6 months to do a new investment, basically.
I think the reason I was asking about the origins, Jason, of infrastructure, I think in many ways it is arguably one of the most ideal assets that a long-term pension fund can have. And it does strike me kind of odd that it only arrived a decade ago. The other frustration I have, which is absolutely true, certainly in the public sector market in the UK, is that people want it. And I signed off strategy 6 years ago at various funds, and they haven't got anything yet invested in infrastructure, partly because they just haven't got the mechanism. So that has been, I think, the frustration in many ways. But I want to ignore my frustrations. Meantime, of course, perhaps there's been suppression of yields and things, particularly on the most desirable infrastructure, which might be the renewables, for example. But audience questions on infrastructure. Who's willing to? Yep, middle left. Please say your name and your organisation.
Thank you. Tristan Powell from SEO Consulting. A number of sort of our institutional clients are very excited about getting into the energy transitions space. I think we haven't quite heard about some of the regulatory risk and how that's being priced in, so I'd be quite interested to hear a bit more. Thank you.
David, is that something you want to regulatory risk?
Yeah, in terms of pricing of that risk, that's regulatory risk. I mean, is there something specific about regulatory risk that?
Yeah, just in terms of the rollback of feed-in tariffs and other quite favourable instruments that we have at the moment.
Sorry, Jason, while you're thinking of the answer to that, I'll just add a little colour to that. One particular infrastructure, direct infrastructure in a fund, was Spanish distribution of, I think, gas or something, and there was a regulatory setback to exactly that, the subsidies and things, and totally unexpected, an event risk. In fact,
Yeah.
I guess there's always that overhang.
Yeah, I mean, that's where I was going to go. Actually, I was thinking about the UK. I mean, there's been, the big example, the sort of boogeyman story about that particular risk was RD 661, Royal Decree 661 in Spain, which was a feed-in tariff that the Spanish Crown had made available to promote, in particular, solar generation in Spain. It's a great solar resource in Spain. And in 2019, February 2019, they introduced Royal Decree 1571, which rolled back 661, which was, as someone that was invested in Spanish solar at the time, pretty painful. So it happens. There's been other instances, some windfall taxes. There's been in the UK in probably 2012, there was a rollback of solar feed-in tariffs, but not for projects that were constructed and had been awarded the feed-in tariff. It was impacting development stage projects that hadn't yet connected to the grid. So yeah, there's risks out there. What are the takeaways for me? We actively do not look to invest in projects that are reliant on government subsidies, or where there is a government subsidy involved. Then we're looking very closely at the territory in which we're investing, the credit effectively of the state, and the extent to which the project is reliant on that tariff, and then what the tariff level is as related to the underlying economic macro-driven driver that's, so for example, with the feed-in tariff in Spain, the feed-in tariff was, I think, 7 times the market price for electricity at that point in time. So in retrospect, yeah, there was a risk. We knew with a risk. No one thought that a G20 country would do that, but yeah, there you go. So it's something you're very conscious of.
And I think sort of more broadly, it's clear that the regulatory environment is more complex. I mean, even in the UK, if you kind of look at what's happened with UK water, and a number of major UK water businesses having to do major capital infusions as a result in the changing approach of the regulator. So I think what that probably means is, also due diligence on the way in around the regulatory environment is becoming increasingly an area of focus.
Other questions from the audience? Anyone? Any hands up? Probably just got, oh, yes. I sense it's ESG, but that's okay.
Kind of, probably. Nivashi from Merton Pension Fund. So question for Doug. First is a silly question. You said you measured the amount of waste came down by 4% during COVID. Why you measure how much waste is disposed? That's my first question. And my second question to you, you're spending more time on looking how do you decarbonize. So when you are negotiating contract, bringing in decarbonize is basically increasing the cost, or is it helping to reduce the cost of the contract?
Okay. So what was the first question again? Sorry, it's not very good. It's not very good.
That was, you said you measured the amount of waste collected during COVID, and you said in London it came down by 4%. How do you measure, and why are you measuring how much waste disposed on a regular basis?
So it's done in tonnage. So we talk about tonnage in waste, and actually it's sort of independently monitored actually. So there are people like in our sector, the sort of most well-known independent is a company called Tolvik, and these would be Tolvik's numbers. The Environment Agency does measure all of this as well, so it produces its own statistics. And then, that's looked at independently to make sure that, what municipals do as well as C&I waste, it all adds up. So broadly 4% by weight. In terms of decarbonising, the waste sector is particularly interesting. Well, I would say that, and actually, if you think about it, it is. But the waste that people throw out, basically 1 ton of waste, if you burn it or put it into landfill, actually, there's a different, will create 1 ton of CO2. So it's pretty significant in terms of what we're doing. And on our site, we process currently about 800,000 tonnes. You can probably do the arithmetic. That's 800,000 tonnes of CO2 that's being produced every year. And with the new plant, that would be 1.5 million tonnes of CO2, for which half of it, which is quite a tricky thing for people, is fossil, and the other half is biogenic. And people only report on their fossil CO2s. I personally find that slightly odd, because ultimately we've got a responsibility to reduce all the CO2 that our communities produce, not just the fossil element. So the cost of this, I think what is well understood is that there's no real commercial use at scale for CO2. I think in London we use about 200,000 tonnes of CO2. Most of it's for various things, whether that be fizzy drinks, which we're then just releasing, or within the nuclear industry, or various other industries. And most of that, I think, is imported from Holland at the moment, or the Netherlands. So there's no real use for it. What government is doing at the moment, it is through BEIS, is supporting a carbon capture scheme for industrial centres, so the northwest of England, the north-east of England particularly. And what it recognises in there, that it's going to have to fund this. And that is currently being developed. It's fairly advanced in terms of contractually, which will be an element of capital contribution, plus, in a sense, an amount per tonne. Whether it's similar to a ROC or a CFD, we don't know yet, but there'll be an amount per tonne of waste which is buried. So ultimately, it's going to have to be funded by the taxpayer, actually, if we're going to capture this, and I think that's well understood. Where it's slightly more nuanced and where the markets are developing is for people who are biogenic, so who are capturing their CO2. Effectively, they're creating negative carbon, and that what they capture there will be tradable. And there is a market developing of private deals. You'll see that there is a trading scheme that sort of exists, but it's super thin, so you couldn't really lend against that at the moment. But that, I think, will also develop in terms of the ability to trade carbon. So in waste, if we capture all the CO2, just over 50% of that will be tradable, because it will be negative carbon. But I think for the moment, in terms of the schemes that we're developing, and so we're very advanced on this, we'll be looking at the moment for government funding for that, while we're keeping our options open for our ability to trade negative carbon.
Okay, if it's very brief, and I promise you'll get a brief response.
Well, I'll try to be brief. Okay, Ed Gemmell, Managing Director, Scientists Warning Europe, and leader of the Climate Party. We're talking about policy and getting, policy that we actually know is going to stay in place. Let's assume that the government got real on the science, and we actually went for a 2030 decarbonisation target for the UK, and we were going to lead the world in decarbonisation. How would that change what you guys would be doing day to day in terms of investment in infrastructure?
Very briefly, let's go along. Peter?
Nothing. Really, we're only invest in green assets because we think they will outperform and will reduce regulatory risk going forward.
Peter, in an earlier version, Peter gave a great quote, which I've copied down. He's interested in the sustainability of people and the planet, which I thought was a rather nice sentiment, I must say. Jason, in response to the question?
Yeah, so environmental and energy transition's one of our 3 pillars that we invest in, and we're spending an increasing amount of time on it. Looking at decarbonisation specifically in CCUS, hydrogen, they're great technologies and they have a lot of macro momentum behind them. And we just need the government, as you say, to get serious and create the framework. Similar to the way the ROC system was originally developed through the noughties and into the last decade, where the government didn't pay producers for producing electricity. They created a framework around which the cost or the revenue for energy producers was allocated to energy consumers through their energy bill. So there needs to be a similar framework created to support these newer, well, I don't want to call them emerging technologies because they're not. They're quite mature scientifically. They're just lacking the capital and the will to industrialise them. But from our perspective, and I know from peers all across the sector, there's a lot of appetite to invest in the sector. We just need governments around the world to create a stable framework within which we can invest, and the capital will come.
David, can you be briefer than Jason? Nothing particular. Yeah. Dougie, final word.
I'm unbelievably frustrated by how fast things are moving. So we're going pretty quickly on this, but you've got to get planning. You've got to get the contractors, you've got to build it, and you've got to commission it. And while the technology exists, there's a lot of people out there, trying to prove that they can do this on an industrial scale. I think if you go flat out from where we are today, you're talking 2027, and we're ahead of the game. And I go to lots of conferences where people are very analytical and all the rest of it, but I don't think we really believe the world is on fire. And I think, if we're going to do something about this, we have to move a hell of a lot quicker than we currently are. So, so I'm very frustrated by it. But it's building, but someone really does need to really mean this if they're going to hit our 2030 targets. So, yeah.
We've run into our coffee break, so can I just ask you to thank the panel in a normal way? Jason, Peter, David and Dougie.